Hi. In this chapter, we will talk about some applications of time value of money. As we have discussed earlier, financial decisions can be broadly categorized into two. One is investment decisions, and the other is financing decisions. But all financial decisions, be they investment or financing, involve two key inputs. One is cash flows, and the other is discount rates. Now, of these two, cash flows are probably the more difficult for a manager to estimate, and they are specific to every investment or financing decisions. By and large, companies follow a uniform set of discount rates for a variety of decisions. Of course, in principle, discount rates should be adjusted depending on the risk of the investment or financing. Valuation of investment uses discount rates to find the present value of a set of cash flows. So when we say an investment is a good investment, what we mean financially is that the present value of the inflows is more than the present value of the outflows. So the present value of inflows minus the present value of outflows is called the net present value. So good investments have a positive net present value. Valuation is subjective. Even though everything reduces to a number, finally, one should not believe that the numbers are objective numbers and the same set of numbers would be derived by everyone where they do conduct the valuation exercise. So the estimation of the cash flows and of the discount rates are both subjective. For example, if you think about investing in a house and you think of it as a 5 year investment, how much would the cash flow be in the next 5 years? Well, there is no certainty about these cash flows, and you would make an estimation. But if I were to do the same estimation, I could come up with a completely different set of numbers. So, this is what we mean when we say valuation is a subjective exercise. Now, for example, if you want to invest in bonds or in stocks, typically you would conduct a valuation exercise. Of course, the valuation is not explicit in all cases. Some investors conduct this very thoroughly, some do not. But large investors who invest big sums of money would definitely conduct a valuation exercise. For example, bonds would involve cash flows over a limited period of time since bonds have a time to maturity, but stocks theoretically will result in cash flows over perpetuity, that is, forever. So, valuation of stocks and bonds starts with an estimation of expected cash flows. Now, what does this estimation involve? Well, you have to answer when will the cash flows happen? Will they happen in year one, year two, year three? How much will be the cash flow in each period? Will it be $100 in year one, $50 in year two? And for how long will the cash flows happen? So, when, how, and how long? So, these are the three key questions that one would have to answer in estimating cash flows. The cash flows are then converted to their present value using an estimated discount rate. Or take another example of an application of the time value of money concept. This is the amortization of a loan. So if you went to a bank and you wanted to borrow a sum of money, let's say to buy a car or a house, then you are taking a loan. The bank has an interest rate that it applies on the loan, depending on the type of the loan, and you would also have to specify how long do you intend to borrow the money from the bank. So given these three factors, the amount of the loan, the interest rate, and the period of the borrowing, you would need to know how much you have to pay every year or every month. This is called the amortization of a loan, and the amortization table is derived using the time value concept. Now, valuation and amortization are only two of many, many applications of time value of money. It would be fair to say that almost all of finance applies the concept of time value of money. Were money not to have any time value, you would not have finance in the form that we see it today. So what's the big picture? Investment decisions involve cash outflows, that is, you first spend money, followed by cash inflows, so you hope to get money back in the future. Financing decisions have the opposite kind of cash flows. Financing decisions have cash inflows, for example, when you take a loan from a bank, followed by cash outflow when you repay the bank. So the cash flows, whether they are of investment or of financing, are discounted using the discount rate. And if the present value of cash outflow is less than the present value of cash inflows, it's a good investment decision. Conversely, a good financing decision would involve the present value of cash inflows being more than the present value of cash outflows.